This is Shelley Kraft coming to you live on SNN Live. We're coming to you from the New Orleans Investment Conference 2016. With me is Rick Rule from Sprott USA. By the way, Sprott is a public company, SII on the Toronto Stock Exchange and SPOXF in the U.S. Rick, welcome back to SNN Live.
Shelley, as always, thank you.
So let's start out with an overview of what you do. You're a speaker, you have a newsletter. Let's talk about you for a minute.
I run the U.S. and part of the international business of Sprott Inc. We manage or administer about $10 billion, principally in natural resources and precious metals. In truth, I'm a credit analyst, but I do a lot of equity work as well. So I help run worldwide portfolios in natural resources and precious metals.
You called the market spot on. From the last time I interviewed you at your own conference in August. Do you still feel the same way about the markets? Well, let's get an update on it because obviously it took a rise, came down again. So where are we?
Precious metals equities markets were overbought in last summer. That was pretty easy to see. And those overvaluations have corrected somewhat, sort of 20%. My suspicion in the very, very near term is that the markets are oversold and will recover a little bit. But I think they will retest the lows. My suspicion is that the bull market will get underway in earnest again, sort of February or March of next year. By today, if you are comfortable 18 months from now, but you might not be comfortable 3 months from now. The truth is, I think we're in sort of the third inning in a 9-inning ball game. I think we have a lot further to go, but we might go lower before we go higher.
Now, what surprised you as we come up to the last quarter, almost over? What was the biggest surprise for you in 2016?
One very pleasant surprise, I guess there's two surprises that were extraordinary. One, I knew that this year would be a good year in precious metals. I didn't have any sense that it would be up 100% in the precious metals equities. The second thing, and this is also a pleasant surprise, is unlike the beginning of the last bull market in 2001, the precious metals mining companies haven't greeted the bull market by doing a whole bunch of stupid things with their newfound wealth. They've actually done a pretty good job with their money. And I suspect, given how many mining CEOs got fired in the bear market, that this newfound intelligence could last for 2 or 3 years to the benefit of all concerned.
When you talk about using the money smartly, do you mean drilling and putting money in the ground?
I mean, no dumb acquisitions yet, no putting really marginal projects into production yet, no boards of directors increasing their emoluments fourfold year on year. Gold mining companies, for the first time in my lifetime, are being run as businesses as opposed to warrants on the gold price, which is really wonderful.
On a scale of 1 to 10, how would you rate 2016, with 10 being the best, and how do you feel 2017 is going to be on a scale of 1 to 10?
11.2 on a scale of 1 to 10 for 2016. I had expected 35 or 40% compound internal rates of return. 35% internal rate of return is astonishing. If you're asking for 35 and somebody gives you 100, that's truly, truly off the scale. My suspicion for next year is what my suspicion for this year was. I would be very happy to see the composite index, the juniors composite index, up 35 or 40% next year. Believe me, I'd be delighted to see it up 100%, but that's not an expectation I have.
Which group did the best over the course of 2016, in your opinion? The explorers, the developers, or the producers?
None of the above. The optionality plays. The people that had very large deposits that weren't economic at $1,100 gold, but might have been economic at $1,500 gold. The optionality plays were up an average of 500%. On a risk-adjusted basis, of course, the big producers did the best because they did well and they didn't have too much risk associated with them. I suspect market leadership will change in 2017, though.
What about M&A? And to me, it's taking place across the board in all sectors of the market. Mm-hmm. But in particular, I see it in the precious metals market. They've been buying up exploration companies. They've been buying up land packages. I've interviewed a few companies that told me that, claims weren't renewed. I mean, to me, that's M&A.
The M&A is going to continue. The truth is that the whole industry needs less general and administrative expense relative to assets under administration. And the way that you do that is through mergers and acquisitions. Now, the best of the best targets have begun to disappear. But this is interesting news for speculators too. You know, the industry has had a dearth of exploration expenditures, which means that the industry as a whole is shrinking. Gold production will begin to fall by 2018. Every other thing left unsaid. What that means is that the better exploration discoveries, the higher quality discoveries, the reservoirs of the world, the Kamenaks of the world, will disappear into the maws of larger mining companies, and they will do so at eye-popping prices. Very, very high-quality new discoveries will go away much in the way that they went away in the 1990s, at prices that surprise everyone.
So they don't disappear, they just have new ownership.
That's correct. That's correct. And by the way, I'm happy to surrender my ownership for correct compensation.
In reality, miners haven't stopped mining. They're taking their own resources out of the ground. How are they going to replace them? And I'm not talking about the giants, the Barricks going out. I'm talking about, the smaller mining companies. Where are they getting their new gold?
It's true in all levels, Shelley. I mean, Barrick is becoming a smaller company too. But what you say is very important for your listeners to understand. This is not a business like a supermarket where fresh groceries come in the back and go out the front. Every day you mine, your business gets smaller. And the truth is that the industry is underinvested for 5 or 10 years. Now, part of this is a natural and normal function that's happening across all businesses called outsourcing. The junior mining companies have cheaper access to capital than the senior mining companies because they have less of a corpus to defend. So, in one sense, the explosion of junior mining companies is a function of outsourcing the exploration function from the majors to the juniors. The truth is, though, that means that successful efforts will become increasingly valuable. When the major mining companies begin to expand as opposed to contract, and the CEO calls down to the exploration department, he'll be reminded by the CFO that he laid them off 3 years ago.
How do you feel about the growth internationally, globally, in the mining and resource industry? Because I'm interviewing companies from Turkey, from the Dominican Republic, from Fiji. I mean, unheard of before.
That's a very important question for your listeners to understand, Shelley. The truth is that deposits are where you find them. And the easy to find projects in places that are regarded as safe have already been found. All those deposits that we could stumble over in Nevada are in production. The big deposits that we find worldwide are going to be in places that are regarded as trickier, that have been less well explored. They'll be in big metallogenic belts, like the Tethyan metallogenic belt. They'll be in Chile. They'll be in places that we are less comfortable going to. Not places that have more political risk, by the way, just places that have political risk that we're unfamiliar with. There's all the political risk that you need in the United States. But the truth is that the big deposits will be found elsewhere.
So if you wanted to advise investors about the gold market, about what they should do, give us a timing answer and give us kind of like a little bit of direction from an expert from Sprott Group. I mean, tell us what you think and what you tell your own investors.
Traditionally, gold has been a flight to quality style asset. It's competed with the U.S. 10-year Treasury. Jim Grant yesterday defined the U.S. 10-year Treasury as return-free risk, meaning that the government absolutely positively guarantees to give you back less than you gave them. What that means is that it's a less viable competitor, and that means that gold should do well. The first thing I can say is if you don't own gold, buy some gold, preserve your purchasing power. If you're prepared to take implementation risk, if you're prepared to speculate, buy the gold stocks. As the gold price goes up, the earnings of gold mining companies will go up and the share prices will follow.
Rick, let's give out your website for more information.
Great. www.sprottglobal, SPROTTGLOBAL.com. If you're in the United States or Canada, 800-477-7853.
Ladies and gentlemen, Rick Rule, Sprott USA. It's a publicly traded company. I'm going to give you two symbols. It's SII on the Toronto Stock Exchange and SPOXF in the U.S. I'm Shelley Kraft. This is SNN Live, and we're coming to you live from the New Orleans Investment Conference 2016. Rick, always a pleasure.
My pleasure, Shelley. Thank you.
Thank you.